Have you ever found yourself, completely caught up in something outside of work?
Oh, that's
Like
not.
maybe you're scrambling to pack for a big trip, checking your flight, that sort of thing.
Yeah, or glued to a game.
Exactly.
Ugh.
Or maybe glued to a major sporting event, totally absorbed, and suddenly that important email you absolutely needed to send just slips your mind.
Mm-hmm. Happens to the best of us.
We've all been there, right?
Oh.
But here's a fascinating question. Does this kind of everyday human distraction, the kind that pulls your attention away, does it actually impact something as, well, seemingly complex and structured as the financial markets?
It's a really great question, and that's exactly what we're diving into today.
Okay.
Our central topic is how investor distraction influences market behavior. Specifically, we're looking at how companies' earnings announcements get processed or maybe not processed by the market when investors are, well, distracted.
And we're not just, throwing ideas around. We're actually breaking down a really cutting-edge study. It's titled, I've Got to Catch a Flight: The Effects of Investor Travel on Earnings Announcement Responses.
Right. By Gupta, Houston, and Liao.
Yeah. And what makes this research so compelling, I think, is that it introduces this novel and frankly kind of surprising way to actually measure investor distraction on a large scale.
It really does. So our mission in this deep dive is basically to pull out the most important nuggets, the key insights from this innovative research.
Okay.
We want to help you quickly get up to speed on these surprising connections between something pretty universal like travel and something intricate like market efficiency.
So the aim is to see how just like flying can reveal deep insights into how markets actually work.
Exactly, uncovering those hidden dynamics.
Okay, so let's set the stage first. When we talk about investor distraction here, what do we mean?
Yeah, good question. Essentially, investor distraction is anything that diverts an investor's focus from their financial work. Think of it like your brain having less processing power available for analyzing stocks or market news.
Like juggling too many things at once.
Precisely. It's like trying to juggle three balls while someone keeps throwing you more. Your ability to react, to make decisions quickly, it's compromised.
And what are the sort of real-world market consequences when investors' attention is spread thin like that? It sounds like it could, ripple outwards.
Oh, it absolutely can. Yeah. When investors are distracted, it often leads to decreased market efficiency, meaning prices might not fully reflect all the available information right away. This can cause mispricing assets valued incorrectly for a time.
Wait.
You also see delayed market reactions to important news, lower trading volumes because people just aren't as active.
Right, they're busy.
Exactly. And in some cases, it might even nudge things towards more passive investment strategies because active trading becomes, well, maybe less effective or responsive in those moments.
That makes a lot of sense. It feels kind of intuitive that distraction would affect markets somehow.
Yeah.
And we've even talked about some of these distraction indicators before, haven't we? Like
Yeah.
big sporting events.
Precisely. We've seen this come up before. Like, there was that 2018 survey showing March Madness leads to billions in lost productivity.
Oh, yeah, the office tools.
Right. Nearly half of workers spending hours on office pools, and other studies have shown trading volumes just plummet during things like the FIFA World Cup. We're talking like 45% fewer trades, 55% lower volume during the 2010 World Cup games. It's significant.
And it's not just sports, is it? I remember holidays and religious events showing similar kinds of patterns.
They do, yeah. Studies consistently show lower trading volumes around major holidays. For instance, earnings announcements around Easter, they've been found to be kind of incorrectly absorbed into prices initially, leading to what's called post-earnings announcement drift, or PEAD, a significant drift later on. We also see effects like herding behavior during Ramadan or reduced trading and delayed reactions during Chinese New Year in relevant markets. It's natural. People are less focused when they're celebrating or often traveling.
I even recall reading something about just regular Fridays showing more investor inattention. Is that right?
Yes, absolutely. Research shows that investor distraction and the mispricing that can follow, it tends to be highest on Fridays.
Huh.
There's a noticeably delayed reaction to earnings news then. The immediate response is something like 15% less compared to other days.
So looking across all these examples, the sports, the holidays, even just Fridays, a kind of pattern starts to emerge, doesn't it? It seems like a lot of these moments of widespread distraction involve people physically moving around, traveling.
Exactly. You hit the nail on the head. And that pattern, that common thread, is what led these researchers to a really innovative idea.
Which,
They noticed that, yeah, a recurring theme in many traditional distraction metrics is the need for travel. People travel for holidays, for big games, for weekend trips. So they asked, okay, what if we could directly measure this travel activity as a proxy for distraction?
which brings us to the big idea of this new study. Using U.S. air traffic data from the FAA, right, between 1990 and 2021.
That's the one. Using that data as a continuous measure of investor distraction. It's a really powerful concept.
Okay, so how does this air traffic idea work? What's the thinking behind it?
Well, the core hypothesis is pretty straightforward. When investors are traveling, especially flying, they're just less focused on market movements. Makes sense, right?
Yeah, intuitively.
And what makes air traffic data so appealing for this is, first, it's easily collected. Second, it gives you a broad, continuous measure of market inattention, not just tied to specific events. And third, it can actually help explain some of the distraction we see around holidays, weekends, and sports, complementing those other measures.
So how do they actually measure it? Are we talking about every single commercial flight taking off?
Not quite every flight. Their main measure is something they call scaled air taxi traffic.
Scaled air taxi traffic. Okay, what does that mean?
So they take the daily number of air taxi flights.
Air taxi specifically.
Yes, and they scale it by the rolling average of flights on the same day of the week over the past year.
Okay, so they're comparing Tuesday's traffic to previous Tuesdays, not just the day before.
Exactly. And the scaling is clever because it accounts for those systematic shifts in traffic over time, like how Tuesdays might normally be busier than Saturdays for business travel. It isolates the unusual spikes or dips in travel.
And why focus on air taxis? Why not just the big commercial airlines we all fly on?
Yeah, this is a really crucial distinction they make. Commercial flights, they're often booked weeks or months in advance, so the shock to investor attention isn't really there, it's planned. Air taxi traffic, on the other hand, is much more volatile. It's often used by more affluent individuals, which includes, professional traders, fund managers, for on-demand, sometimes last-minute flights. So the thinking is that spikes in air taxi traffic are a much stronger signal of their personal distraction and reduced market focus compared to just overall commercial traffic. That's kind of a proxy for the on-the-move financial professional.
That makes a lot of sense, actually. So did they check if this new measure holds water? Did it line up with things we already know cause distraction, like holidays?
They did, and yeah, it correlated pretty well. Their air traffic measures showed a strong positive correlation with known U.S. high travel days, like Fridays and around Easter weekend.
Okay, that builds confidence.
It does. It suggests their proxy for distraction is capturing something real about U.S. travel patterns.
But then there's a twist, right?
Yeah.
What about non-U.S. holidays? Did it correlate there too?
Well, this is where it gets nuanced and actually strengthens the finding, in a way. They found a negative correlation with non-U.S. holidays like Chinese New Year and Ramadan.
Negative. How so?
It likely reflects the fact that these aren't public holidays in the U.S. So the specific U.S.-based investor sample they're primarily looking at is probably less likely to be traveling extensively during those times compared to typical days. It shows the measure is quite specific to U.S.-based investor behavior.
Interesting. Okay, so the measure seems to track travel patterns. Did they see any immediate sort of real-world market impacts just from this air traffic measure itself?
Right.
Even before looking at company earnings news?
Yes, they did. And it lines up perfectly with the distraction idea. They found that on days when this scaled air taxi traffic is above the median level, trading volume is significantly lower, about 1.60% turnover compared to 1.77% when air traffic is below median.
So people are literally trading less.
Exactly. And also the bid-ask spreads, that's the gap between buying and selling prices, tend to be wider.
Indicating less liquidity.
Right. Markets are a bit harder to trade in. So this clearly raises a big question. If investors are less active and markets are less liquid when travel is high, how does that affect how they react to really important time-sensitive news like earnings announcements?
Which brings us right to the core findings on earnings announcements. Let's start with that immediate investor response. Hypothesis 1, right? What did they find about how quickly or how strongly investors reacted to earnings surprises when air traffic was high?
The finding here is pretty striking. Investor reactions to earnings surprises, good or bad, are significantly lessened on days with high-scaled air taxi traffic.
Muted, so less of a reaction.
Yes. To put it simply, When investors are, metaphorically or even literally up in the air, their immediate reaction to company earnings news is significantly dulled.
Okay.
For instance, for a company that meets or beats earnings expectations, just a 1% increase in this air taxi traffic measure on the announcement day corresponds to almost a 1% decrease in the immediate positive stock return that day. It basically means the market's initial thumbs up for good news is weaker than you'd expect, simply because fewer people are paying close attention right at that moment.
So that muted delayed reaction, it sounds like it could directly feed into that phenomenon you mentioned earlier, P8, post-earnings announcement drift. Can
Exactly.
you quickly remind us what PEAD is again?
Sure. So PA is this well-known market anomaly, this tendency for stock prices to keep drifting, slowly moving in the direction of an earnings surprise for quite some time after the initial announcement day.
Well,
So imagine investors are traveling, maybe they miss or only partially absorb the initial earnings news, but the news is still out there, right? Days or even weeks later, as they get back, catch up, re-engage with the market, they start trading on that information they initially missed or underreacted to. This causes the stock price to continue adjusting, sometimes even more significantly over time than it did on day one. That delayed, often amplified effect is PA.
got it. And the study's second hypothesis was that PA would be higher for firms reporting earnings on these higher taxi traffic days.
Precisely. And that's exactly what they found. The logic is that distracted investors don't fully process the news immediately.
Right.
So when they eventually do get back to their desks, so to speak, they spot the discrepancy, the stock hasn't moved enough yet to reflect the news, and they trade on it. This leads to that delayed but often more substantial price adjustment over the following weeks or months.
Do they have numbers on that?
Yeah, they found for a firm meeting or beating expectations, a 1% increase in air taxi traffic on announcement day corresponds to a noticeable increase in the subsequent price drift over the following 2 to 60 trading days. So the drift is bigger when initial attention is lower.
Okay, so muted initial reaction, bigger delayed drift. What about trading volume itself? Hypothesis 3. If people are traveling and distracted, presumably they're just not trading as much around that specific company's news.
Yes, that's the third piece, and it confirms the mechanism. The study found that abnormal scaled trading volume, so volume adjusted for normal levels, is indeed lower when investor inattention, proxied by this air taxi traffic measure, is high.
How much lower?
A 1% increase in air taxi traffic was associated with anywhere from a 0.08% to about a 3.44% decrease in trading volume, depending on the exact specification. It clearly confirms investors are just less active, less engaged when they're traveling.
Yeah, I can totally picture that. Friday afternoon, trying to wrap things up before a long weekend. You need to catch that flight. Market analysis probably takes a back seat.
Absolutely.
So now let's dig a bit deeper and refine this picture. Does the location of all this air traffic matter? You mentioned air taxis are often used by finance pros. Are flights out of, say, New York or California more impactful than flights elsewhere?
Yes, they looked into that, and it turns out location really matters. The study found that air traffic specifically in major financial centers like California and New York is even more predictive of this investor inattention effect.
More predictive how?
Well, for firms meeting or beating expectations, a 1% increase in flight traffic originating from just CA or NY leads to an even larger decrease in the immediate stock return, close to 1% down. And importantly, it leads to a bigger subsequent price drift, that PE effect.
Wow. Okay, so the effect is concentrated. What about flights from less financially active states? Did they look at that?
They did. They contrasted it with states having, say, the highest poverty rates, which tend to be less concentrated financial hubs, states like Mississippi, Louisiana, New Mexico.
And the result?
Air traffic originating from those states showed no significant relationship with how investors responded to earnings surprises.
So what's the big takeaway there? It really suggests it's the distraction of the key financial players, who are often concentrated in those major hubs, that's driving these market-wide effects on pricing.
That's the clear implication, yes. It's not just any travel, but travel by those most likely to be moving markets that has the strongest impact.
Fascinating. They also ran several other checks, right? Robustness checks to make sure the findings were solid, like looking at midweek versus Fridays or excluding holidays altogether.
Yes, they really stress tested their results. And interestingly, when they specifically excluded announcements made on Mondays and Fridays, days often associated with travel or lower attention anyway, and focused only on Tuesdays, Wednesdays, and Thursdays, the dampening effect of air traffic on the immediate investor response was even stronger.
Really? So it's even more pronounced on supposedly normal trading days if travel is high.
Exactly. It suggests the effect isn't just a Friday phenomenon or a holiday phenomenon.
And what about removing holidays entirely from the analysis? Did that change the results?
When they removed announcements made around major holidays, the negative immediate reaction to earnings news associated with high air traffic was, again, even stronger. It reinforces the idea that this is about a fundamental link between travel-induced distraction and market reaction, not just noise around specific calendar events.
Okay, one more check that caught my eye. Shareholder concentration. Does it matter if a company's stock is held mostly by a few big institutions versus lots of smaller individual shareholders? Where was this distraction effect stronger?
Yeah, this was a really interesting nuance. You might expect the effect to be stronger for firms owned by concentrated, sophisticated institutions, right?
Maybe, yeah, because they're the ones using air taxis.
That was my initial thought, too. But they found the opposite. The investor and attention relationship, the muted response and higher drift, was actually strongest in firms with more diffuse ownership.
Diffuse meaning. Lots of different shareholders, many smaller ones.
Exactly. Companies with a wider base of shareholders, including more individual investors rather than those dominated by just a few big institutional players.
What does that suggest?
It perhaps suggests a broader market impact. Maybe the big institutions have ways to mitigate distraction, or perhaps the effect aggregates across many slightly distracted smaller investors to create the overall market phenomenon. It's definitely food for thought.
It really is. And finally, a very relevant check given recent history. How did the whole relationship between air traffic and investor response look before and after the COVID-19 pandemic? Did things change?
They did find a difference there. The study reported that air taxi traffic had a significantly stronger impact on investor responses, both the immediate reaction and the drift before COVID-19 compared to the period afterward.
Interesting. Why might that be?
Well, the paper speculates it could be due to shifts in travel patterns post-COVID, or maybe changes in work habits.
Like remote work?
Exactly.
Yeah.
The massive shift to remote work and perhaps better digital connectivity even while traveling might be making investors less susceptible to purely travel-induced inattention than they used to be. Maybe they're just better equipped to stay plugged in even from 30,000 feet nowadays.
Yeah, that makes sense. Okay, so let's try and wrap this up. To recap our deep dive today, this study presents a really compelling case for using air traffic, especially that scaled air taxi traffic, as a powerful and novel proxy for investor inattention. And this widespread distraction, measured by travel, seems to lead to some clear market effects. Muted immediate reactions to earnings news, a larger subsequent post-earnings announcement drift, and just generally lower trading volume.
That's a great summary. It's a really elegant new measure that helps explain some previously observed market anomalies, like PEED in a fresh way.
So what for you, the listener, listening to this?
Well, for individual investors, I think understanding these patterns could be useful. It might suggest times when information is more likely to be perhaps mispriced initially, or when delayed reactions might create opportunities.
Because the market overlooks something.
Potentially, yeah. It highlights periods where paying closer attention might yield insights that the broader, distracted market initially missed.
And what about for, say, corporate managers or even policymakers? Are there takeaways for them?
Absolutely. There's a crucial implication here. It suggests that while managers might be tempted to, strategically release bad news on days when they expect investors to be distracted, like a high travel day.
Right, hoping to soften the blow.
Exactly, hoping to mask the immediate impact. But the research clearly shows that while the immediate reaction is likely to be muted, doing so actually leads to a greater magnitude of negative share price drift later on.
So the bad news doesn't just vanish.
Not at all. It just gets delayed and potentially amplified when investors eventually catch up and fully process it. It speaks volumes about transparency and timing.
That's a really important point for corporate communication strategy.
It is, and it leads us to a final, maybe provocative thought to leave everyone with.
Okay.
How might this new way of thinking about investor distraction, using something as seemingly simple as travel patterns, extend beyond just earnings announcements? What other critical corporate news or even broader economic data releases might be affected when a significant chunk of the market is traveling?
Yeah.
And how could understanding this phenomenon change how we think about market efficiency, especially now in this age of supposed constant connectivity? What stands out to you?